In the wake of the 2008 financial crisis, firms had to quickly adapt to a number of changes in the financial markets. As these regulations continued to evolve, market participants needed to make updates and enhancements to their infrastructure without being sure the latest rules would be the final ones. Rather than taking different routes to satisfy all the changes coming your way, we can help you re-examine your infrastructure and optimize operations by taking a holistic approach. Our consulting framework covers diagnostics, analysis to help address inefficiencies related to DTCC products and services. Design, helping define and organize operating models and technical architecture. Implementation, planning, testing, and coordination of solutions. Project management, overseeing initiatives by subject matter experts. Integration, support through your onboarding journey.
Now my pleasure to introduce you to our next panel, Industry Leaders, Perspectives and Outlook. This panel is moderated by Jonathan Lombardo, ISLA Chairman and Senior Vice President, Head of Unit, Eurex. The panel are going to cover a range of topics and issues that have impacted the securities lending market over this year. They will also be looking to the future and will provide some insight as to what their business will be focusing on. We don't often get to hear from the business managers, so I'm very interested in hearing their thoughts. Many thanks to Natixis Corporate and Investment Banking, who have kindly sponsored this session. And just a quick reminder, don't forget to use the questions functions and submit questions to the moderator. Over to you, Jonathan.
Thank you, Tina, and thank you for the introduction. So as the panel is called, it's the Industry Leaders panel. And what I'd like to do first and foremost is to allow the esteemed panelists to introduce themselves. So may I please start with Joanna?
Hi, good afternoon. My name is Joanna Armita. I'm head of Securities Lending in Europe for Goldman Sachs, covering both equities and corporate bonds on the desk.
Fantastic. Thank you very much. Daniela, please.
Danielle Nugem, I'm head of Securities Lending and Repo at Amundi.
Fantastic. Thank you very much. Mr. Templeman.
Good morning, good afternoon, everybody. James Templeman. So I am responsible for securities lending for the EMEA business, and I'm global head of trading for Sec Lending.
Fantastic. And finally, Simon.
Good afternoon, everyone. Simon Tomlinson. I run the agency lending trading for BNY Mellon. Been in the bank for about 16 years now, and took over this role in 2019 to spend more time in a virtual environment than in the office.
So thank you for that. And that's a perfect introduction to one of the first questions that I would like to put to the panel. You know, one of the key aspects of this year has been the gradual return to normality with a return to the office. And, very curious to see how the transition of returning to work has been received by the staff, by management, and has that expectation of both sides been met and matched? So maybe, Joanna, from a dealer perspective, what are you experiencing at Goldman Sachs?
Look, I wanted to say thank you first for inviting me to this panel. That's a great pleasure. Look, if we look at Goldman Sachs, we clearly believe that the center of gravity of our workforce is in our offices, and that it's important to have all our people together. That's mainly driven by the fact that we evolve in a creative and innovative environment, which presupposes teams to be together and share ideas. We strongly believe as well in a culture of apprenticeships, where the young generation learns by looking at and observing at the senior ones. As we bring our staff back, we clearly are focusing on securing a safe workplace, and we'll continue to make sure that our people feel comfortable into our working environment. I would say that we have, of course, learned a great deal through the pandemic, right? And we have proved that it has worked. And there will be flexibility. We need to recognize, though, that there isn't one size fits for all policy, and that some tasks actually are better suited to working from home than others. So I think this is why we currently having discussions that are taking place between individual teams and managers and figuring out how to best work it for the future and understand as well how to have the right work-life balance.
Very interesting. Thank you for that. Danielle, maybe from an asset manager, Paris-based organization, do you see your company following the same suit?
No, here on Paris, on an asset management perspective, the management did agree on allowing up to 2 days working from home, even on the trading floor. So that was highly uncertain and highly appreciated by the staff. So it's on a voluntary basis, so it's flexible. And the only thing is, it's more for the desk managers. It's a challenge to set up rules and to find a way to make this work, because as Joanne mentioned, it's very important to keep the dynamics of everyone being together. So basically, the rules globally was to set up some essential prerequisites, such as at least 1 or 2 days where everyone is in, and then to have every day at least one desk representative. So once you set up, the setup is defined, the staff is now globally very happy to be able to have this flexibility. Now, the challenge is really to find the best way to work in this hybrid configuration to keep this intellectual sharing capacity intact. And I think it will take several months and maybe years to see the evolution and the impact of this hybrid way of work. It's new on the trading floor, so we need to see that this setup, which is becoming our new normality, to make sure that there is no negative impact on innovation and growth.
Interesting. Thank you for those comments. We've heard flexibility, we've heard kind of intellectual share. So, James, over to you for a quick second. Flexibility being a key component to the return to the office strategy. During our prep call, you mentioned you had a really great phrase. The genie is out of the bottle, right? We've opened up Pandora's box a little bit. Do you kind of see flexibility now being an essential tool to retain and attract new talent? I mean, is this now a prerequisite when new entrants are coming into the market?
Yeah, I think it is. I mean, as Joe said, I think it does depend on roles, but I think generally people want flexibility. They want flexibility in terms of when they can take time off and dress code and hours in the office. So I think, that's what people expect going forward, obviously within the constraints that the business has to operate within. I think the really interesting thing was through the pandemic is that people proved they could, work effectively from home, be really productive, and you don't need to be in the office to get the job done. I think we need to move away from that slightly old-fashioned thinking of we need people in the office from 9 to 5 so we can make sure that they're not slacking off. So I think that's what was really demonstrated. People are hardworking and professional, and they don't need managers to be looking over their shoulder. But I also think we have to acknowledge that the reason it worked so well and businesses were able to operate in that remote environment is that lots of teams had worked together for a long period of time leading up to that. So they had that deep level of understanding of how they work with one another, and they trusted each other. And so that kind of carried us through that period of full-time working from home. So I think going forward, it's just going to be about getting the balance right. I do think the genie is out of the bottle in terms of, we've demonstrated that working from home can be effective. But as Joe said, there's some things that are well suited to doing from home. You don't need to answer emails if you're just in the office. If you want to write a proposal, you can do that from home. But it's obviously better to be in the office when you want to work with others and when you want to collaborate. And My favorite quote on this, which is what our COO reminds us of regularly, it's his favorite saying, I think, is that Zoom wasn't invented on Zoom. It was developed by people collaborating with one another, in an office. And so I think, working from home is definitely fine, but I think we also want people to collaborate and work with one another.
Fantastic. Thanks for that. And Simon, maybe you could draw a little bit on that last comment about, the intellectual share that, we may be missing, even though offices are trying to get back to 100% capacity. In reality, we know that's not really happening. Do you feel that there's an opportunity being missed from an innovation and growth perspective because we don't have those teams in all the time?
That's a good question, John. And maybe I should just quickly outline my sort of personal situation and that of the firm around return to office. I mean, we're still predominantly work from home, as are most to some extent. I mean, I know, Joe, you're back in Goldman's much more than most. Our return to office has been delayed many times. I mean, at the moment we have pilot schemes on where people are invited to come back. The take-up's been okay, but it could be better, and it will. I guess the trajectory is going up there. On a personal level, my home situation was always somewhat challenging, just down to lack of internet service where I live. That's been rectified recently, thank God, because my kids will now stop telling me to sell the house down and move. That's been driving me mad. So, but I mean, back to the point. Look, I mean, has it affected innovation? I think when I look at BMI Mellon, what we've achieved over the last 18 months has been fantastic. We've added, new people, new products, new collateral options. We've signed up to new platforms. So I think the answer for me, really simply, is no. I haven't seen that. Do I miss the in-person aspect of being in the office? Yes, I do. I go in 3 days a week now. So, that's fantastic. A lot of my staff are coming in now. You definitely miss that in-person sort of chat, that free flow of information that you get in the office. You can't replicate that virtually, no matter how hard you try. Or it becomes much more regimented if you do try and do that virtually. So I think, in a nutshell, no. I think we've actually really sort of embraced that virtual aspect, really worked hard to sort of try and develop the business. And the only thing that is missing is that sort of free flow of information around the personal side of being in person.
So innovation, revenue opportunities, they're still there. They're still being created. There's real no downside of not being all in the office at the same time, other than that, that kind of buzz that comes from the experience of going to work.
I guess you just have to work harder at it when you're at home, right? You have to schedule more meetings. You have to, make that, everything's 30 minutes. I want to have a 5-minute conversation with someone, but you have to book out 30 minutes to get in their diary. So it's a little bit hard on that respect, but it doesn't mean it's impossible. So I feel like it's, we've done pretty well across this period as an industry, and certainly I feel pretty good about how BMI Mellon's acted and reacted to across this time.
Thanks for that, Simon. Why don't we kind of look back a little bit into 2021 and look, there's been some critical events that have occurred in 2021, right? So we all know the names: GameStop, the retail squeezes from a Reddit perspective, the collapse of Archegos. I don't want anyone to make any comments about those specific events, but obviously there's been some impact and change of behavior. So, where are we seeing those changes? And James, maybe I could start with you on this one to talk about, are we seeing from an asset owner perspective, maybe short selling practices, trading behavior, has it shifted a little bit? Is there a kind of new dynamic coming down the pike?
Yes, sure, Jonathan. I'm happy to start with that one. And I think, if we go back to the start of last year, it still blows my mind that GameStop, meme stock, Reddit army, whatever you want to call it, that happened, and that retail investors were able to use a combination of, social media, free trading apps, and I guess a dislike of short selling to squeeze hedge funds out of position. It's like if we'd have been on this panel a year ago and you'd have asked me for a prediction, that definitely wouldn't have been on my list of predictions for 2021. I mean, the feedback that I've heard, and this is secondhand, because obviously on the lender side of the equation, this is not something that I deal with explicitly. But from the feedback I get is that that obviously what we saw was hedge funds, closing a number of hard to borrow positions in January and February of last year. And I think that, to a certain extent, the scars are still there in terms of it is something that it's an additional risk that now needs to be managed. So, checking on, short interest utilizations, whether or not there's any risk that stock that they want to short is crowded. I think they're much more sensitive to that risk now than probably they were a year ago, even for GC names. There's a certain level of scrutiny around, just is there anything going to happen with that name? Is it going to heat in some way? And so I think there's a number of ways that hedge funds, responded to that additional risk. One is, just look for less crowded opportunities. The second is stay underneath disclosure positions so that it's not in the public domain. And the other thing that we've seen a lot of is ETFs being used instead for short exposure as a proxy for either sectors or parts of parts of sectors, because obviously there's much less risk of being squeezed out. But I think the other thing that I would say, looking back over the year, is it hasn't been a great environment for short selling anyway. And so, there is obviously a lot of liquidity in the market. It's one of those markets where, there's been a rising tide and kind of all boats have been floated higher with it. And so the feedback is it's much harder to find, good quality, high conviction short positions. And even if you do, there's always a risk that there's some M&A activity, or there's private equity or SPACs in the US where there's a lot of liquidity on the sidelines looking for companies to buy. So there's always a risk that you find a high quality short and then you get taken out of the position through some kind of M&A activity. So I think the net result, I guess, for the lender community is there's definitely been fewer specials in the lending market. I think it's been a year where we focus much more on COACs, IPOs in the US, capital raising and tender offers in EMEA. And as I mentioned, ETFs, there's been a lot more demand for ETFs in the US and in Europe. I think we've seen a real growth in European ETF market this year for the first time. So I guess the question is, is this just a short-term phenomena? Is this something that will fade away in time? Or, is this a permanent additional risk that hedge funds will need to manage and will therefore kind of have an impact on specialness going forward? So I guess time will tell with that one.
Sure. Right. Thank you for that, James. So, we've seen obviously with these events comes political pressure, right? And I guess one of the questions I have is, political pressure, short selling, is this leading towards asset owner exodus, right? Are we going to see a pullout of liquidity in some of the markets? So maybe Danielle, from an asset long-only asset perspective, what are you seeing in that space? What are you hearing?
Well, when you look at it from a rather conservative European asset management world, short selling is like a sort of a bad word. Huh? Some conservative funds, and it's not new, it's been there for several years. A lot of funds don't want to participate in securities lending because they associate short selling that's been blamed historically on several occasions for market crashes and labeled as unethical by some. So there was even short bans on short selling several times in the past around the world. So this GameStop event reopens the debate, of course, and it's back again. And even though when you look at the studies, they all point out that bottom line short selling has been found to be actually to increase market efficiency, but these arguments that say that securities lending is good for market efficiency, for liquidity, for risk management, even for information for the funds, this is not necessarily what some portfolio managers have in priority. They just don't want to be part of that, of short selling business, mostly for reputational purposes, because investors think it's dark, it lacks transparency, which if you go back once again several years ago, maybe you did not have this transparency we have today. Huh? The regulatory framework evolved a lot, SFTR reports, the taxes regulation. So a lot of things did happen on the market with regard to transparency, but still some fund managers, they are not updated with all what's going on in the securities lending, and they are still stuck with this idea. They don't like securities lending because it's they associate directly to short selling. So once again, to avoid that, of course, a lot of things are being put in place to bring comfort. So you put limits on lending activities, or you look at the ADTV, you put limits on market cap, etc. A lot of things that you can put in place to avoid having this the fact that fund managers, they don't want to do securities lending because of just short selling. So this year, to come back on what happened this year, definitely I think there was an impact indeed, just like you mentioned, because we saw after that a lot less specials trading outside in the market. So there is an impact. Will this, once again, as you mentioned, will this be recurrent or just temporarily? Then we'll see. Time will tell. But from an asset manager's perspective, this is how it is. It's not new, and it's always been skeptical with regard to this. Now, coming back on the question about the critical events that occurred in 2021 outside the short selling business, and I'm speaking as a European asset lender, agent lender, what did have an impact here is Brexit. The market is still highly concentrated in the UK and in the US. In the ISLA market report issued in June, it is reported that the on-loan values are increasing more quickly within the UK compared to the EU. And when you look as well in the same report at the SFTR statistic on the single-sided reports, they show that most of the liquidity are coming from outside Europe. So bottom line, as a European asset manager, I think it's important to highlight the fact that we need to see a European hub. We need local European demand. We need to see European hedge fund rise. And so we will see once again if in the near future or just in the future, there could be a strong European marketplace as well for these activities.
Fantastic. That's great insight there. Thank you, Danielle. I mean, Simon, you run a lot, Bank of New York is one of the world's largest agent lenders, custodians. I mean, are you seeing similar reaction from some of your beneficial owners?
Simple answer is no, really. I mean, look, we always get lots of questions around any type of market event, but we've not seen any panic. We've not seen any restriction on lending. We certainly haven't seen any exodus. This year is an interesting one, right? I mean, before this year, you had the Wirecard situation that came out there, which was extremely interesting for everyone. You saw a BaFin initiate a short sale ban on a single stock, but clearly then proved to be a bad choice because quite clearly that there was malpractice in that business, right? So I think short selling, has been proven over the years to actually weed out that type of activity, right? I think clients see that. This year's a bit different, right? I mean, the way the market sort of changed this year is it's more like when I look at the events of GameStop in January, it feels more like a market manipulation and sort of the intersection of social media coming together. And you said, James, about free platforms and apps and stuff, and just that whole retail growth. But I don't think the politicians jump on the back of that. Clearly, they're going to because it's Main Street versus the Wall Street type argument that always comes around. But I think we're all pretty well prepared now. We've seen loads of white papers around the benefits of short selling to sort of defend that position. So I think that sort of faded away quite quickly. What we will see is more disclosure requirements quite clearly and things like that. But I think that's going to push clients out of the business, John. I think clients are familiar. And plus, our business is much bigger than just short selling, right? There's so much more to it than that.
Agreed. And James, I mean, from a BlackRock perspective, your view on short selling, I assume would echo a little bit of Simon's take. I mean, can you elaborate a little bit on that, or?
Yeah, no, absolutely. I mean, I don't think short selling is really a controversial issue for our clients. I think there is consensus that short selling is generally beneficial to markets. And every study has kind of shown that it doesn't reduce asset prices and that it's not contrary to long-term value. So I think what Danielle said was really interesting because, I mean, I've certainly met some fund managers over the years who are less keen on short selling or have a particular type of portfolio that they don't think is applicable to, or they don't want it to be lent because they don't want, it to be available for short sellers. So I think that's a different kind of issue. That's where they perceive their interests are slightly different to, say, a hedge fund's interest. But I think from a client perspective, I don't think that any of the events in 2021 has reignited any kind of issues for asset owners. And in fact, I think the issues around GameStop, I think, were more about transparency. And so I think in EMEA, as Danielle said, we've got transparency now. We have SFTR. I think there's a lot of data around this short selling disclosure. So I think the reaction in the US was probably, okay, there probably needs to be more transparency around short selling rather than short selling itself being an issue.
Understood. Okay, great. Thanks for that. I mean, listen, at the end of the day, it's not all negative news, right? I mean, we've seen continuous growth in the markets. Global lendable assets are at 25 trillion plus. On loan balances are at 3.9 trillion. So, we said it before, our market has shown amazing resilience. I mean, I just saw there was a press announcement that came out yesterday that year-on-year growth from a sec lending point of view was positive. So, with all of this happening, and we're in a very extreme low interest rate environment, there's a lot of growth in the passive AUM sector. Has cash reinvestment opportunities really started to rise up? And Simon, maybe I'll start this off with you first, from a beneficial owner perspective.
Yeah, sure. I mean, we all enjoyed a really strong tailwind last year. Late Q1, Q2, on the back of all of the emergency rate cuts that we saw. That benefit receded quite quickly as the forward rate guidance went, out to 23 and beyond. And I guess the yield curve just flattened very dramatically. So, I mean, you have to go looking for them, John, right? You have to go looking for these opportunities. So we, as a business, try to expand our equity repo offering. That's probably our best performing asset class in the cash space right now. Beyond that, we sort of moved into the sterling side of the business. Prior to that, we focused on Canadian dollars, US dollars, and euros, and added sterling. That's been a good add to the business, and we've seen some really good increase in balances. And with the forward guidance that you saw on the panel earlier, like how that's looking now, like rate increases are sort of looking more likely next year, certainly in the UK and even the US towards the end of the year. So I think, whilst those traditional avenues remain challenged, there were opportunities, ETF repo, JGB repo, even converts now on the back of all the issuance last year. So, you have to go looking for these opportunities. And I think the same argument for cash exists that does on non-cash, right? Clients that have collateral flexibility will see the best opportunities. If you're just going to be an overnight govy client, you're just going to be limited into what you can do. So they're there. I don't think they're necessarily new. I think the value is just more appreciated in this low rate environment.
Fantastic. And maybe, Joanna, just from a dealer perspective, I mean, is this opening up an endless vault of opportunity for you guys?
So look, I wanted maybe to spend a bit more time on the macro side, right, to explain some of the client positioning and I think some of the supply that we've seen coming from the lending community. And I wanted maybe to share with the audience some, I thought, really interesting numbers regarding the growth of the equity market. So if we look at global equities, we've seen 756 billion of inflows year to date, which is making it the first best ever 9-month inflow ever by a factor of 3 times. If we look at the ECM activity, right, it has been incredible with record deals issuance. You look at IPOs, SPACs, CBs, like just equity issuance year to date are greater than 1 trillion. And there's been almost $4 trillion of bond issuance. And we look at like the retail participation in the US equity market, it's been tremendous and it's been well documented. Even just looking at US households, right, its net worth rose by 5.8 trillion to a refresh record of $141 trillion, according to the Fed. So I would say whatever way you want to cut it, there's been a quite incredible market period and index returns, which have lived up to that as well. Just look at the SPX, it's up like 16% year to date. Despite the recent wobbles. So it's likely fair to argue that many of these stats, right, have a degree of linkage to the Fed balance sheet expansion and the overall government stimulus. But I would say that has clearly translated into, one, the growth that we've seen on the lendable AUM, with asset owners and beneficial owners and agent lender. And as well, that explains as well, I would say, some of the overall client book positioning. And maybe I'll drill a bit on my side from a client side perspective, right? Like if you look at like just maybe Q1, and I would say even if we started the year with a pretty eventful start of the year where we've seen a lot of market event dislocation between stock fundamentals and price performance, and some clearly changing behavior that James highlighted around like decent unwind of crowded shorts. You look at then Q2, and what we've seen is a different story with a lot of risk on flow. Both if we look at gross and net leverage, they have been almost at all-time high. And that means that we've seen client positioning largely skewed towards long position. And when we look at the hedging side of it, to the point that James highlighted with some of the ETF, we've seen like a growth in macro products in order to hedge the net length of the book from a client perspective. And that has been done through sector swap, ETF, index future, and custom baskets. When we look at maybe the question around nervousness around disclosure, I would say, yes, it's there, but it sort of have dissipated a bit. Just, I think, mainly as well, we don't have really a strong single short conviction position. They're really hard to find at the moment. And that mainly is explained by, I would say, the overall macro environment and the government stimulus that we've just described earlier. I will pause it here.
No, thank you very much for that. Very insightful again. Daniela, do you echo the same sentiment from a European perspective? Do you see your AUM in your passive funds, is that steadily growing? And are you seeing more utilization away from the kind of short selling, the credit short selling into a wider range of products?
So from an asset manager perspective, I majorly use its funds. To be honest, today what really is driving the business is the regulation. There are so many things we can't do, so we can't see. We are very focused on indeed, what we saw is increase in balances. We did see a lot of demand. We did see a lot of GC out there. But the one thing I wanted to point out in this perspective is that we really need the regulation to be less conservative with regard to UCITS funds. So a lot of the things we don't have the right to trade. It's not UCITS compliant. So maybe we will. I don't know if I can jump in now on basically what the challenges we are facing as an asset manager with regard to this perspective and the growth of the AUM globally. What we need to do here on an asset manager perspective is to make the best use of an asset. It's to optimize the existing assets. So how do we do that in a regulatory framework that is really conservative? So now we have UMR, we have collateral, the pledge structure that most of our counterparties are asking for. So all these, they have an impact on our businesses, and the way we drive the business is really focused on that today. For example, we are reconsidering the way we operate. So once again, the regulation forces us to change our behavior. So whether it's for UMR or for the use of assets or securities lending and repo, it's all a matter of how to optimize this. And for that, we need a centralized system. We need to work on data management. We need to gain efficiency in the way we operate. So globally in the market, we see less silo across desk, but more centralized desk. And this is what we are focusing on here. We need technology as a prerequisite for that, to have reliable and updated information. So this is more of our constraints today on an asset management perspective.
Fantastic, thank you for that. And it's a great, it was a great segue. So I'd like to kind of build a little bit up on that, on your comments, is that, where do we collectively see some of the challenges or the need for new solutions to be developed in 2022? Do we see UMR, collateral, pledge, regulatory change, Basel IV, CSDR, all having a major impact on our industry? So maybe James, Daniela kind of gave us a precursor to her kind of thoughts on that. Maybe James, you could build out on that a little bit.
Sure. I mean, I definitely have similar thoughts as to Danielle in terms of the UCITS funds. I mean, obviously with our iShares franchise, we have similar restrictions in terms of what those funds can and cannot do from a sec lending perspective because of regulation. And I think over time, what we'll see is increasingly different outcomes for clients because of the move that you were really just describing, Jonathan, in terms of like as we think ahead to more regulatory change. I mean, in a way, Basel IV, etc. It's really just a continuation of a trend that we've seen for years in that banks need to borrow assets as efficiently as they can. And so, whether that's collateral or pledge, or, moving towards, more flexible non-cash collateral schedules, I think we still just push more and more in that direction. And for the lenders, for the beneficial owners that can participate, there's definitely opportunities there. There's definitely challenges, as I said, around, clients and being limited from a regulatory perspective. But I think the challenge, and I think Simon probably would agree with this, from a lender's perspective, is how do we do a better job of like differentiating between different assets according to their underlying characteristics. So some funds are going to be able to utilize, pledge with a very flexible schedule. And so an asset that a borrower wants to source from that particular lender probably should have a different price than an asset that's being borrowed from a lender with a very restrictive schedule that can only, accept US Treasuries versus transfer of title, for example. And so I think looking ahead as kind of challenges for us, I think the challenge is the system development that we need, the differentiation we need to build into the program so you can segment inventory according to its characteristics and then kind of price it accordingly. Right. Which would then enable us to, to provide the borrowers with what they need in terms of, kind of improving the way that they manage either their balance sheet or their capital.
Okay. And Simon, I mean, would you kind of say that some of these regulatory challenges that are coming down the pike is, again, going back to, is it scaring some of the beneficial owners to say, wow, yet again, another wave coming at us. How are we going to really maximize alpha in this kind of environment?
I guess, again, no, simple answer is no, not really. I mean, look, we have lots of good dialogue with the clients. We've got a pretty expansive program. James just mentioned how do you sort of segment the different client types, the different collateral types, how do you get paid. This market has a habit, and no offence, Joe, the borrowers, whenever they come to us with new products, they don't want to pay any extra money for them, right? So it's trying to extract that additional value from their saving, right? We're all trying to do that. So I think that's just the to and fro and the push and pull that goes on in this industry anyway. But I think if I think about the challenges for next year, CSDRs is a huge one for all of us, right? From both a solution perspective and a challenge, right? The need for vendor solutions that can help you identify, penalty risk. There's some good vendors out there now that are looking at that solution. That's going to be really helpful. But does it lead the market into slightly different behaviour? Does it lead, and I'll be interested to see what Jo thinks about this when she goes. Like, does it move us to more of a same day return type environment? Does it change the way, borrowers use their automation around returns? And all of these sort of things will affect how we do business, and it to some extent, maybe change the way liquidity works in the market. So I think CSDR is a massive challenge. I think pledge is very well established. We've been in that now since 2018. We have a large client base there. I think that just gets bigger. I think more people look at that. I think smart buckets and RWA is another big factor at a borrower level. So that's something you need to be able to manage. But it goes back to something that James just said about all of these things sort of isolate certain types of clients, right? So how do you sort of stop those guys really suffering? You need to have that broad spectrum. But unfortunately, just the way the market's moving, limited resources, borrowers really sort of narrowing down into certain types of collateral, trade types, RWA, it's going to do that. You're going to have this like core client base in the middle that sort of basically fits everything, and then everyone else sits around the periphery, which is going to be challenging for us as an agent to deal with.
Okay, thanks for that. And Joanna, it sounds, I mean, do you have handcuffs now getting on yourself? I mean, there's so many things that you have to take into consideration, resources, technology. How do you build to accommodate for all of these, these kind of anticipated changes?
Look, I think the reality is we continue to focus on regulatory hurdles, right? Like you look at NSFR, CCAR, GSIB, RWA. And in order to manage, our liquidity and capital metrics, I think we all need tools to pivot around these challenges. And to the point of Simon and James, we look at pledge when it comes to broadening collateral, Hong Kong Connect, taking high yield, IG, etc. We look at smart bucketing. We look at CCPs. We look at the ability to be able to, from lenders and agent lenders, to provide secured financing across different maturities. But at the end of the day, counterparties who will have the capacity to adapt to these industry needs will be the one gaining market share. I would touch base maybe on UMR, because clearly that has a huge economic impact for both the buy side and the sell side, since entities are forced to post segregated IM. And that's, for me, it's clearly an investment in data, optimization and workflow that are a key focus to make sure that we increase financing efficiencies across the stack. And that means that we are all investing in getting access to clean data, and where we can see all the position across the equities, across the fixed income and derivative desk, to make sure that we know how best to mobilize that collateral. And we have to bring down those silos to reduce inefficiencies. And again, we've seen some of these tri-party platform services, building or providing this service to clients to help from a UMR perspective. And maybe the last point to Sai's point is CSDR, right? This is clearly a new regime that we'll all have to comply and adapt in the coming year. And it's been a really big focus on our side to review current processes and getting really under the skin of the current settlement efficiency rates. And we look at SSI mismatch that we're facing, collateral to be agreed in a timely manner. Look, vendor connectivity, in my view here, is more important than anything else.
Interesting. Just a reminder to the audience, if there's any questions, please use the app. We will try to address all the questions. But yeah, if there's any questions out there, please fire them over. Okay, so look, let's talk a little bit about technology. I mean, obviously, not from an application point of view, but some of the new technology that's coming down the pipe for us, DLT, crypto. Let's focus a little bit on DLT for a second. I mean, do we see this as a revenue opportunity? Do we see this as a post-trade operational efficiency tool? Is it, collateral management? I think for that, I'll start again with Joanna, and I'll work my way backwards from the first open panel question. So where do you see DLT and possibly crypto in our world?
So look, maybe because GS has been pretty vocal in that space. And I would say, look, it's a growing theme, right? An exciting, I think, opportunities for the securities finance complex. But when I look at DLT, I will split it in two categories. I would say the DLT when it comes to pre and post trade cycle. And I mean by this, looking at billing, clearing, SSI, corporate actions, onboarding. I think it's the all capital market cycle being on a ledger. And again, greater efficiency, but I think we're still a long way to go. There's a lot of work that is needed to ensure that we have the legal framework of DLT arrangements that are sound, that we have governance structures that are robust, and technology solutions that meet industry needs. But when I look as well, when around DLT, it's from a collateral perspective. And I think that's, in my view, a reduction in terms of costs. And when I look at this, we speak about tokenization of collateral, right? And I mean by this, the digital representation of an underlying collateral, that it can be equities, fixed income, or cash that are traded on a blockchain. From a liquidity perspective and a high level, and I don't want to spend too much time on this, but we believe that tokenization helps with instant settlement, settlement precision, mobilization of liquid collateral, reduction of collateral, and we are really seeing progress in that space. You look at trading repo on blockchain, you see as well like the likes of HQLX being imminent. But again, I think it's important to highlight that the latter clearly needs critical mass adoption to be effective.
Thank you for that, Simon. Let's let me flip that to you from a large bank. Wheels. It's hard to turn a big ship sometimes. How are you embracing, this kind of move towards DLT? And we'll leave crypto out to the side of this conversation for now, but any insight that you could provide for us?
Look, Joe did a pretty good job there on this sort of describing how it might sort of impact the market. I see the potential for both sides, from both a revenue perspective and a post-trade efficiency perspective, right? It's no secret that we've signed up to the HQX platform with one of their Series B investors. We also agree with Joe in the sense that I think that ability to sort of unlock trapped assets, to remove some of the friction in the market, mobilize collateral. We all like to talk about mobilizing collateral. That seems to be the big thing nowadays. The DVD sort of atomic settlement, instantaneous settlement, and intraday aspect of it. It's all quite compelling. I think we see it as definitely a good step forward in terms of the future. I think, to Joe's point, there's a lot of things that need to happen to make it successful. Regulatory acceptance, like market adoption. The old new tech meeting old tech is always going to be a challenge. So I think we all believe in it quite clearly because we've invested, and I think that we'll be trading on that platform relatively soon. And I think that will lead to more business and more revenues from my perspective. Whether the borrowers, I'll go back to my point before, the push and pull of whether we get paid more for those types of frictionless transactions remains to be seen. And then on the post-trade side, look, there's no doubt that SFTR has improved post-trade, right? All the work that went into that and how people have embraced that. But we can still do better. CSDR is going to be another catalyst for me that sort of will help drive this agenda, John. So I think there's a lot more to come for DLT, and I think it's the sort of thing that probably will accelerate over the next year or two.
Okay, thanks. And Danielle, maybe I can come to you to ask you, obviously all of this new technology needs investment, right? And if you're concentrating so much on the regulatory side, is there time to make that investment to get your program up to speed from a digital perspective? What can you do there?
Yeah, we will need to find time, and we'll try and find time because it's absolutely necessary. Given all the manual work that is currently on all the post-trade that you mentioned, so it's the same thing on asset management side, and it's even worse because, if I can say worse, but we have all this onboarding process that is really complicated, time-consuming, the portfolio analysis, the documentation exchanges, and on all these aspects, I think DLT could be quite useful, and we will need to find time to develop and to invest into these technologies because it's going to be time saved elsewhere. The time we are spending today doing all this manual work is the time we need to invest in DLT to avoid having that in the future.
Fantastic. Thank you for that. So, and James, do you want to kind of round it off for us? What's BlackRock's view here in the DLT space?
Yeah, BlackRock is definitely excited about the application of DLT. So, funnily enough, I think from a resourcing perspective, it's actually sometimes easier to get resources to look at something that's got digital ledger in front of it because there's a central pool of expertise that you can draw on and you can get people involved. Sometimes it's easier to do that than it is just to get a simple system change in the lending systems. But I don't think it's an either or thing. So I don't think I would have a strong conviction or would know enough to say it's post-trade or it's collateral or it's revenue. But we are excited about the application of a digital ledger to post-trade services just because, as Simon said, we still spend way too much time maintaining lending transactions over the life cycle of the the trade. And there's a lot of contract compare work and billing compare. And we all have, at the end of the day, different books and records that we're trying to reconcile all the time. So the idea of having, one central kind of golden source of truth, if you like, I think is exciting. Now, I think there's tons of work to get there from an industry perspective, but we certainly could see the benefits of, the operational benefits and cost savings, I think could be, pretty significant if we didn't need to focus so much time and energy on some of the post-trade work that we need to do now. Now, that doesn't necessarily have to be a DLT type solution, so I could see other ways and other types of fintech companies could potentially solve that. But I think a digital ledger does seem to be a really good opportunity, particularly because of the nature of lending transactions being open transactions over weeks, months, or years. That does seem like that could be a pretty good use case.
Sure. And I guess it kind of offset to that to bring standardization is obviously a lot of the work that ISLA has been doing in the common domain model, right? Looking for that kind of one unique language where everyone could really adapt to that practice. Listen, we're coming on to a close of time, so let's move on to something that we could probably spend the rest of the day on, but obviously there's a panel tomorrow on it. It's ESG, right? So, ESG has definitely created by far the largest seismic shift to the financial sector, that I've seen in a bit of my career. With all business lines across all asset classes really kind of getting impacted by this. So I guess my question to the group is, how are your organizations embracing this change? And is this more of an asset owner issue that the kind of sell side has to buy because of responsible investment strategies and looking to make those, to stand into the ESG space, or is it something greater than that? So, I know I just ended with you, James. Maybe I could go back to you for a second. Where do you see that? Where do you see, obviously, ESG being a big focus of BlackRock, but is it really more buy-side eccentric from a practical point of view?
I think that it possibly is at the moment, although I think that will change over time. I mean, ESG investing is definitely it's definitely real. It's here to stay. When we look at the flows across, say, the ETF book, it's breaking records. I think we surpassed the 2020 AUM into ETFs in about July this year. And even through the last few weeks, where obviously markets have been a bit sideways, we still see very strong flows into ETFs. So I think that's the first thing that we would say. It's definitely a real focus for clients. Virtually all client conversations will revolve around ESG investing, whether or not that's from the investment management side or the sec lending side. I think the second thing that we would say is that we see obviously sec lending being really good for markets, really good for investors. It increases liquidity, reduces trading costs, boosts portfolio returns, etc. And we think there's absolutely no reason why an ESG portfolio would want to miss out on those benefits. So we see sec lending and ESG being absolutely compatible. Now, I know we might want to talk about collateral and how you match collateral criteria and voting. But I think they're all just characteristics of how you manage the program itself. And so I guess I'm conscious of time, and I want to leave time for everyone to comment on this. So I would just kind of say that that's our view, really, is that sec lending and ESG are absolutely compatible with one another. And that, we all need to prepare for, ESG investing being, the theme for the next, 5-10 years, because I think, that's where clients are going.
Okay. Daniela, maybe I could get a comment from yourself.
Yes, I'll try and be quick. ESG is one of those you can spend the day talking about ESG, especially on an asset manager, and especially at Amundi, who is really ESG focused. What is ESG basically? I mean, okay, we all know it's about environment, socially responsible, solidarity, but it's also about acting for transparency, equity, parity. Okay, there is saving the planet, but how do you reconcile all these with securities lending, knowing that in March this year, there is the Sustainable Finance Disclosure Regulation that came into practice, so the SFDR. And it's about transparency, it's about governance, it's about integrating sustainability risk. So now you have to classify the funds. You have Articles 6, 8, and 9, where you classify the funds depending on their investment strategy. So they force asset managers to reveal the different levels of sustainability integration. So clearly it has a huge impact. It's a lot of focus internally on that, because this is what investors want. It's something that that everyone's looking for today. It's a change in society, and it starts with the financial world. The financial world is driving the change in society thanks to ESG. Now, how do you reconcile once again this with securities lending? So a lot of questions to be to discuss about. We need to discuss about the voting rights. We need to discuss about the transparency. We need to discuss about the collateral you mentioned. How do you make sure, given the grades of your portfolio, that the collateral you take in is not going to downgrade your portfolio, even inside an ESG environment? It's going to ask a lot of work in terms of following all the grades of each company. And we can also ask ourselves questions such as, will some companies who are not ESG compliant will have access to financing, to liquidity, to capital? How is this going to be to change the future? It's more questions than answers today, but clearly it's going to have a huge impact. I'm just trying to be quick.
I've got a 2-minute warning now. So maybe I had a few more questions. Obviously, the great panel. We could have talked a lot longer. Maybe I could get a 30-second prediction for 2022 from each one of you. So why don't I do this, Joanne? Why don't I start with you? A 2022 prediction. Where do you see us next year? 30 seconds.
God, amazing. Look, I think we've seen a robust business mix this year across the corporate activity, and I believe that's something that will continue in 2022. On the corporate bond side, I would assume that if Fed starts tapering and we start seeing increase in interest rates, we should see additional shorts coming on the corporate bond book. And then again, like big focus on emerging markets, China, Saudi, Kuwait. I think this is all a trend that we need to start like looking and focusing and continuing on that one.
Fantastic. Thank you for that. Simon?
What she said, to be honest with you. I mean, I agree with all of that sort of stuff. I think there'll be more fundamental short activity next year. I think that will be interesting to see how that pans out based around some of the comments that James and all of us have made around behaviour of funds and fear of crowding. I think the tapering will happen and the interest rates will go up. So we will see more of a curve. We'll get some more cash reinvestment opportunities. You know, the dividend sort of blocks that we're on over the last sort of year or so, certainly for the banks, are off. So I think we'll see more payouts in the dividend space. So I think, I'm buoyant, John. I think there's plenty coming.
Danielle, really quick, if you may, and then James.
What they said. We're adding a specific aspect in France. Will follow up also on the possible consequences of having the election for presidency the next year. We will follow the prices of gas and all the impacts that this could have. So all these are stuff that you need to follow. Just trying to be quick.
Great, thank you. And James as the wrap.
Yeah, it's always a nightmare going fourth in the prediction section. Predictions are a fool's game anyway. I mean, I guess the one thing that hasn't been mentioned, I really think that next year is going to be a big year for the European ETFs in terms of lending and borrowing. We've definitely seen a lot more demand this year, and I think finally that ecosystem is growing. Lenders are making more inventory available, and I think as that happens, it's going to fuel more demand. So I think, finally, hopefully the European ETF lending and borrowing market is going to catch up with the US.
Fantastic. Thank you very much. So thank you to my panelists. Thank you for everyone that listened. Enjoy the rest of the day. Thank you.